Thanks for being patient, everybody. Still people are coming in, so we thought we would give it a few more minutes until we begin. Now, if you have come today to hear what the top tier of private real estate and private equity guys are doing in this asset class, I think you've come to the right place. We have, as you'll know from your program notes, a pretty heavyweight lineup of people to be involved today in alphabetical order. Let's see if I can get this right. We've got GIC, the Government of Singapore Investment Corporation, in the shape of Bernard Pang. We've got Lone Star and Juan Pepper over there. The far side, we've got TPG Capital, Mr. Robert Weaver. And last but not least, we have the Wellcome Trust here in the shape of Peter Pereira Gray. Now, I don't mind kicking things off by giving you a brief introduction to these organisations. So rather than hear the official spiel, maybe as a journalist I can give you kind of a sort of a third-party assessment, a rough one, albeit, and they can tell me if I'm going wrong. But anyway, GIC, it's of course a sovereign wealth fund from Singapore, evidently. It still remains quite a private organisation. As I was talking with Bernard earlier, GIC still does not like to reveal the amount of assets under management that it has. That said, I've seen it written that it has, several $100 billion of US dollars of assets under management around the world. So I think we can say it's a pretty big organization. What I do know is that it is a major participant in real estate, and we'll hear more about this, no doubt, from Bernard as we go along. But it is going to be fascinating to find out what GIC thinks about European real estate and distressed investing and so on in the course of this discussion. Lone Star, a company I know a little bit more about. It's probably one of the few organizations, I would say, that's capable of raising multi-billion-dollar real estate funds nowadays, because after all, the competitive field has shrunk and the best performers are still able actually to attract dollars to invest in property in the global markets. Europe has been a focus for Lone Star over the last few years. They've taken down some pretty big deals, and you'll know that they're quite famous for buying, I would say, large pools of loans from financial institutions. And Juan, I think, will be prepared to talk in the round about some of the deals that they've been up to and what they'll see, what they'll be doing going forward. TPG Capital, perhaps better known as Texas Pacific Group. Some of you may recognize that name better than TPG. It's a premier brand private equity firm, right, from the States. It's up there with KKR and Bain Capital and the likes. And in my preparation for today's panel, I looked at one of the last funds they raised. And Bob, I think I'm right in saying that TPG raised, it's probably 2009, a buyout fund which measured about 18 billion US dollars. This is to buy, obviously, companies, fix them up and sell them on for profit. That's the game. Robert Weaver is here because TPG fairly recently made the decision to build out a real estate platform and get involved in the real estate side of things sort of more organizationally. And so we're going to find out what a mainstream private equity firm is doing in real estate, what it sees out there, and particularly in Europe. Given the audience here today, I'm assuming is mainly European focused. And lastly, the Wellcome Trust. I've interviewed Peter over the years a number of times. The Wellcome Trust, I think, has, again, Peter will correct me if I'm wrong here, about 14 billion euros of assets under management, something like that. A little bit more, he says. It's a UK sort of a charity, a charitable foundation, and it's 75 years old. And also discovered last night that, well, this is 2006. It was the only UK-based charitable foundation to have a AAA rating. Is that still the case? So that is still the case. So he's doing better than some countries, the Wellcome Trust. I could make myself unpopular and talk about, is France still AAA rated? I think it just is just about clinging on. And have we got any Italians here? I feel like a game show host here. Have you, any Italians? Obviously, There are countries around the world that are struggling a little bit, but the Wellcome Trust is doing well. It's clung on to the AAA rating. Anyway, I will shut up in a minute. That's my preamble. I've bigged up these organisations, but you know, it's fair to set the context before we get stuck into the main conversation, which is what these guys are doing in real estate investing. I'm going to ask Bob Weaver to set the scene in terms of where is private equity real estate at the moment. It has suffered. It has suffered just like mainstream property investors, and there have been some big changes that have taken place. So, Bob, I'm going to turn to you. Sum up, if you can, quite briefly, where private equity real estate is at the moment. Thank you.
Thanks very much, Robin. I was accused of doing some preparation. I do have a piece of paper. I'm not very good with numbers, and I can't do anything with numbers unless I've got them in front of me. So to talk about how private equity real estate has suffered, let me share a couple of numbers with you. In 2008, there were closings in real estate private equity funds to the tune of $142 billion. That was the peak year of fundraising in private equity real estate. The total in 2009, 10, and 11 together is $139 billion. So you've got the last 3 years that have equaled the fundraising of the peak year in 2007, and you can be sure that the GP, the general partner community, has not shrunk by 2/3. So there is a real scramble among the general partnership community to raise capital among a shrinking community of capital availability. That doesn't necessarily mean a shrinking pool of capital, but the limited partners and investors, sovereign wealth funds, pension funds, endowments have been able to and have been acting accordingly in a much more discerning manner. They're asking tougher questions, they're asking more questions, they're taking longer to make their decisions, and there's going to be a shakeout. There is a shakeout, and there's going to be, you know, fewer people in the market tomorrow than there have been over the last 10 years. The GP community is broadly broken down between financially sponsored organizations that own real estate management firms and independent operators. And if you look at the financially owned firms, people like Lehman are gone. They had a real estate business. Others with real estate business, Citibank, Bear Stearns. Goldman Sachs continues to be in the business, but not on the opportunistic side of the business. Merrill Lynch has sold their business as they merged in with Bank of America. More close to home in Europe, ING last year sold its business. Deutsche Bank is selling its REIF business. So there's been a major, major shakeout in terms of the financially sponsored firms. And others, like Blackstone, like Lone Star, have consolidated their position in the marketplace. And so what you're seeing is a real emergence of the powers in the business.
Thanks, Bob. And yet, as you say, there are a few number of firms able to raise large funds. TPG, I'm assuming, wants to come in and do a similar thing. Why is a mainstream private equity firm going into real estate?
Sure. And I'll do this as much as possible without a commercial. That's certainly not the intention. But TPG is a firm that buys companies, fixes companies, and sells companies. We've managed over the last 3 years to do that with 3 different real estate companies that have been purchased by the private equity fund. And we've got a view that bringing a corporate angle to real estate investment in the U.S. and in Europe is something that some people do. We think we can do it well, and we think that there's a business opportunity to pursue that. And if you look at the limited partners around the world, the investors around the world value you know, the franchise and the people that our firm has got, and we think that we can extend our business into that asset class.
Okay, thanks, Bob. So let's get stuck into the meat of this conversation. Juan, Lone Star, distressed real estate investing, Europe. We read about the firm quite frequently taking down some big deals. What is it that your firm has been doing? What are you seeing out there? Tell us a little bit about that.
Yes, absolutely. Good morning. I'd say it's chronologically, we are in 2012. In Europe, maybe the crisis, we could say, started in the summer of 2007. From a Lone Star perspective, we closed some funds, 10 billion in June 2008. And there was a first wave of, if we're going to call it, banks willing to dispose, clean up their balance sheet, mostly investment banks, between 2008, 2009. We were very active in Europe, investing on those transactions. We closed probably deals in terms of value of the assets behind for 5.5 billion euros. That was in a period of maybe 16 months investing. 2010, everybody here can say that there was not much product actually to buy in Europe. There was not really much to do from an acquisition perspective. We had invested all of our funds that we had raised in '08, so we focused really in giving the money back to our LPs, selling, refinancing, working out our portfolios. We have been selling since then, more or less in Europe, 150 million euros worth per month. We have, even if at the Lone Star level it's just a small team, we have over 350 people in Europe that work for our servicer, Hudson Advisors, which is also our asset manager. And then I would say that there was a second wave, which is probably starting post last summer. Timing-wise for us, it was very good because we closed another 10 billion between our two funds last June, dollars to invest. And in the last, I would say, probably 2-3 months, we have been also, again, very active on the buy side, continue active selling stuff. And we made deals probably worth 3 billion euros in Europe so far.
And have you been more active in Europe than you have in, say, North America or Asia?
I'd say we have been very active both in the States and in Europe vis-a-vis Japan, which is for us Asia at the moment.
So first came the US, would you say, in terms of the opportunity?
Yes, it started first and in Europe.
Okay. Bernard, let's bring you in then. I said earlier that I'm curious to learn a little bit more about GIC. So Lone Star's been able to take down some pretty big distressed deals that we've just heard. How does GIC currently view Europe as a place to invest? Are you interested in distressed property?
Sure. I think when I told my boss in Singapore that I'm coming here to speak on a panel about European distressed investing, his response is, what distress? And I guess if you look at the prime end of the market especially, the pricing that the prime assets are being sold at or transacted at, it's a question whether there's a distress in Europe or not. The few main conditions, I guess, for investment is one is that there must be confidence in the market, which I think there's a big lack of confidence in the European property market at the moment. Secondly is there must be growth. And I think in Europe, that is also not really, you don't see a lot of growth. There's anemic growth, for the next 2, 3, 4, 5 years. And the third element is financing. And I think that is also lacking in Europe at the moment, as the banks are retreating back for various reasons that has been well articulated. So there really isn't a lot of things going for investing in Europe at the moment. But nonetheless, I think Europe is a significant part of our investment universe. It's here to stay. We don't believe that Europe is going to disappear by any means. So we still believe in the long-term prospect of Europe. So where are we looking to invest in Europe? I talk about prime end. We like to invest in prime assets, don't get me wrong. It's just that I think for us to make the deal work, there has to be some adjustment in pricing expectation. At the moment, I just don't think we can make the numbers stack up, given the prices. Where we find interesting investment opportunity is actually in, if you like, value add or good secondary assets. And we've done a number of those things, mostly separate arrangements with niche players that operate under the radar screen. And in the last 2 years, they've done very well, buying smaller assets in smaller cities in the UK, which has not been the focus of a lot of investors, especially foreign investors. And also in Germany, it's been quite a good story in Germany. Surprising, maybe, even in Italy, we bought into a few secondary units in partnerships, if you like, because the LPs wanted to pull back from Europe. So just want to get rid of those investments, and we have a look at it. And we said we'll do it, but only at this price. And they accepted it, so we went and do it. So that's sort of some of the things that we're looking at. Of course, the other thing I should mention is debt financing. I think it's well accepted there's a lack of financing, both at the junior as well as the senior level. At the moment, we are very much focusing on junior debt. We like senior, but at the moment, senior is not giving the sort of returns that we need as a real estate investor. So we are having internal discussion right now about whether we can find the right source of fund within GIC to do senior debt. It's a question of your cost of capital. At the moment, the cost of capital for real estate is a lot higher, but there's certainly a pocket somewhere that we think it would make sense for us to put some of those money to work in the senior property debt. And is that in Europe, or are you talking about globally, actually? That's pretty much, I'm talking so much more about Europe. Right. In US, we have done debt in quite a significant way. Especially, I think 2 years ago, we have an arrangement with a group that actually bought quite a significant size of CMBSs, the secondary market, and there was nobody buying at that time. So in fact, we were able to acquire quite a significant portion of some CMBSs, and it's done very well. I think it's incredibly well. In Europe, the CMBS market is not that big. So the opportunity is not there yet, and we're primarily focusing on financing for new transactions rather than buying secondary loans, which people like Lone Stars would do, and we sort of invest with them and let them do those kind of investment for us. So actually, you could work with Lone Star effectively and finance one of their transactions. Is that the kind of thing you would do? Yeah, I mean, broker deal here. We invest with one and so on. So
I have to report to them what we do.
That's interesting. Okay, thank you. By the way, you just to be clear, also, Bernard, before we leave you in this section, are you still investing in real estate funds, the types that these guys would manage, or are you trying to do things more in separate arrangements, sort of club vehicle type arrangements? Okay, we do both, really. For us, it's a question of, do we think we can do the job ourselves, or do we think that other people can do it better than us? I don't think it's possible for us, given our mandate and footprint, to try and do everything in-house. For those assets that are more straightforward, if you buy a building with a single let tenant or 2 or 3 tenants, City of London, for example, or even Paris, we have a small asset management team, and we do it in-house. But if it's more, I guess, labor intensive or specialized, like take hotel, for example, and even to extend shopping centers, they are very specialized. They are non-performing loans that is very labor intensive. You need hundreds of people, lawyers and so on, involved in negotiations and foreclosure. Those things we invest through funds and let other people do the job, who we think can do better than us. So we do both, depending on the risk and also the intensity for asset management efforts. Thanks, Bernard. You've told us more than I expected, I have to say. Very good. Peter, just touching on the ways into real estate at the moment, the Wellcome Trust has not been the biggest fan, I think it's fair to say, of recently anyway, of investing in real estate funds. Is it true to say that you're really preferring to do things direct? And also, could you tell us how the Wellcome Trust just sees real estate as an asset class? After all, your job is not purely real estate, you are also investing in other asset classes, correct? So how do you see things at the moment?
So Wellcome is unusual because we do not strategically asset allocate. That is to say, there's no formal allocation to a particular weighting in any particular asset class. We think that our particular characteristics allow us to do that. And I guess what that means is that essentially every asset in our whole total portfolio competes against every other asset class, every other asset. And so we are making both top-down decisions and bottom-up decisions at the same time, and we're relatively opportunistic. Our required return is, I believe, rather higher than Bernard's. And we are risk takers and wish to be paid for that. And so one of the interesting challenges for our real estate team is that they don't have the comfort blanket of knowing that we are trying to allocate a certain amount of capital to real estate. We have no innate geographical bias that is preferred, and so we approach life just slightly differently. And I'll agree with an awful lot of what Bernard said in terms of how he reads Europe and pricing for real estate. I would say much the same. We find pricing relatively expensive for real estate assets today in the context, in Europe, in the context of what else we can do with our money. And that is the essential challenge that we have. We will think about everything we do in a matrix form, which is boiled down simply into thinking about control, thinking about liquidity, thinking about return, and thinking about risk. And we try to meld those four things together to think about the attractions of doing anything and the form in which we do it, whether we do it directly or whether we do it indirectly. Now, it is fair to say that we have struggled a little with what the real estate fund model has offered to the industry in recent years. One of the challenges is clearly articulated in our own annual report and accounts, because we break out and compare the returns that we've earned from the activities where we have managed our own affairs in real estate directly, compared with what our fund managers have managed to do for us. And there is actually quite a significant premium difference. And I'm afraid, from the point of view of the fund managers, they have got a bit of a catch-up to go, it has to be said. So I see the case for real estate funds, but we find them, because we've got quite a lot of capital, and because we are able to think differently, we find them relatively inflexible, and we find that they haven't performed awfully well. And so we have preferred to do things ourselves, or indeed to co-invest alongside fund managers, but not to be direct investors in real estate funds recently. If I pick up on something Bob said, completely agree with your numbers in terms of the drop-off in real estate funds. I've got some numbers, and I don't know how correct they are, but something in the order of 115, 120 funds closed in real estate in 2011, raising something around $45 billion. Okay? So the average fund size there is in the order of 400 million or so, just playing pure averages. And I appreciate, Juan, you've been fantastically successful, one of the largest real estate fundraisers, and you skew the numbers. But actually, from a Wellcome Trust perspective, I wouldn't want to be more than, say, 10% of a fund. And if the average fund size is 400 million, that's a $40 million investment. And you know what? To be honest with you, that's a bit small for us. And then actually you tumble into the numbers more in detail, and you find that this guy here has actually raised many billions of dollars in one fund. Actually, the averages in most of those funds are smaller than that. And so this is relatively hard for us to deploy capital in a fund that we like, with a manager we trust, in the quantum and size that we like, to get the degree of control and participation that we'd like. So Wellcome's a bit special. I don't think that should necessarily be the way every investor approach fund investing, but that is the way we do.
I pick up on that, and I'd agree with it wholeheartedly. I think if you take an honest look at how the GPLP relationship has played out over the last few years in the context of the fund manager, with very few exceptions, it's been awful. There was too much leverage, there was too much velocity, the prices were too high. The thought and care given to the investments, particularly during the peak of the cycle, was inadequate, and there's a reason that there's been a retrenchment and a consolidation and a shakeout. And I think that one of the things that the investors around the world learned is that, to the extent that we're large, like Wellcome, like GIC, like some of the sovereign funds that everybody's been hearing about over the last few years, there is a better way, and that way may be to retain some discretion, to make larger allocations to investors on better terms with better governance and retaining better control. But there continues to be a number of smaller investors in the world that really do need the fund model, either because they can't get the diversification if they do a deal-by-deal strategy, and they just don't have sometimes the numbers to, if it's for example, if it's a $10 billion pension plan and they'd like to have 5% in real estate, there really aren't the GPs out there that are going to be able to work with them on a separate account basis. So it is definitely different courses for different horses. But I think that I've got all the respect in the world for the investors that have got the staff and the know-how and the capacity to work with general partners. And I think that the general partners that survive and flourish over the next 5 to 10 years are going to be people that get that and adapt to it, because there will be some people that don't, and I think what they're going to find is they're just not going to be able to attract capital in the ways that they used to.
Robert, assuming that you can convince the investor community that perhaps they should invest with TPG in real estate, what is it that you're going to be telling them in terms of the opportunity in Europe? And is TPG, are you currently looking at deals? Are you taking anything to investment committee? Are you getting much traction with counterparties and so on? Do you have a general thesis?
Sure. Let me touch not on the TPG angle as much as an investment thesis that we've got brewing that picks up very much, Bernard, on something that you were talking about, and that is that the rush to core assets over the last 3 years has been profound and I think in some ways unprecedented. And what chief investment officers around the world saw is that well, let me say it differently. The question that CIOs ask themselves is, remind myself why we're investing in real estate. And investing in real estate is not necessarily to make 20% returns annually for 7 years in a row, but rather it's to provide some diversification, some correlation benefits to the broader portfolio, some yield, and frankly, some safety. And a lot of those tenets went out the window a bit. And what's happened as people have rushed to core is you've had some markets, and let me pick on London and Paris, for example, that have arguably been overbought. And with yields in the 3%, 4%, even 4.5% range, while it may be attractive relative to the fixed income alternative, it's historically, on a price per foot basis, higher than it's ever been. So one of the things that we're thinking through is, are there select secondary markets, probably more focused on better assets, but select secondary markets that have got good office-using employment growth that are being overlooked. And so that might be a French market outside of Paris, it might be a UK market outside of London, perhaps it's Edinburgh, perhaps it's Manchester, pick your market. But we're trying to find places where there might be a good opportunity to buy portfolios or platforms outside of the prime markets, because the historical spreads, or rather the spreads today, are 300, 400, 500 basis points wider than what you might get in the city. So we're looking hard at that market, and I think it sounds quite familiar to what you just articulated, Bernard.
So can I come in on that as well? If I take my real estate hat off and put my CIO hat on, there's some really interesting challenges out there. So to take Rob's point, yields in prime markets have come down to, you quoted 3 or 4% or whatever. I can today, the next 3 minutes on my iPad, buy global mega cap equities, right, to achieve a dividend yield in excess of 4%, a basket of them, huge global franchises, very powerful management, very clear regulatory and legislative frameworks, instant liquidity. 30% of their P&L often exposed to faster growing markets, emerging markets and economies, in a very uncertain world. I think there's a challenge here for anyone to persuade Wellcome that we prefer prime real estate at 4% with all the liquidity and questionable control, particularly if it's coming in a fund type structure, to compete against that global mega cap equity baseline. I'm not sitting here saying I think everyone should go out and invest in global mega cap equities. What I'm trying to say is that we need to have a very, very careful sense of proportion of value as we conduct our investment activities from a Wellcome Trust perspective. And I think that we almost certainly wouldn't go out and buy prime real estate today. I do, however, agree it starts to get interesting as you start to be prepared to take more risk. But the fundamentals of this asset class, quite brutally, are this. It requires an awful lot of capital, whether that is coming from equity or whether that is coming from debt. The pressures in the world today, from a regulatory perspective for the providers of equity, whether it's AIFM, whether it's Solvency II, whether it's Basel III, whether it's slotting rules of FSA in the UK, whatever, is that there's less equity around for real estate today. There's also a brutal truth that we know there's a lot less debt around for real estate today. And you know what? I would say, as a non-real estate professional, looking down as a CIO, those are pretty overwhelming pressures. And in the absence, as Bernard has said, of short-term growth and a relative lack of capital, you know what? This is hard to find real value.
Yeah, I think one of the... can you hear me? Okay. One of the... All right, that's better. I think one of the reasons that you've often heard about why people are buying prime assets or assets at 4-5% cap rate is they said, well, if you look at the bond yield today, right, what do? You buy bonds, you know, what sort of return do you think you can get? And the premium or the spread between bond yield and property yield has been highest it's ever been, or near its highest ever been. And that's sort of the rationale, if you like, that people justify or explain why cap rate for prime assets is as low as they are. But I will make one observation. Bonds are very liquid, and there are a huge volume of transactions going every day. You can get in and out of bond markets, you know, as Peter said, with a click of a button. That's not the case with real estate. You buy real estate, you spend 3 months, 6 months negotiating documents, doing due diligence, underwriting, so on and so forth. You're not going to be able to flip it the next day when bond rate goes up and those spread disappear. What do you do? You know, when bond yields go back to 4-5%, does it make sense to own real estate at 4-5 cap rate? Where will cap rate go to when that time comes? And are you able to get out of it when you want to, when interest rate goes back up again? And it will. It's a question of time, I think. You know, cycles come and go, and I always saw as long as there are human beings involved, there will be cycle. It's a psychology of human nature. One thing I maybe I didn't mention, I should mention, is also one way that we are playing the real estate market is also in the listed side. We do invest in REITs and listed property stocks in Europe and around the world. And if you look around the world, some of these REITs and stocks are trading at a very significant discount to the underlying NAV. Now, of course, the immediate question is, you know, what are those NAV? Are they reliable NAV? Are they going to drop 10% next year? Those are all valid questions, but you can buy pretty good REITs today in Europe that use 5-6% from dividend, well-covered dividends. And they're trading at, I don't know, 15-20% discount to NAV. So maybe there's a way to play, and that's an area that we are also scrutinizing and buying into selectively some of these listed property stocks or REITs.
Thanks. Juan, let's... it is working. Juan, let's bring you in again from Lone Star. So you are finding presumably deals that will give you over the long term 20% plus returns from these large distressed property loan pools. I know you don't want to talk specifics in terms of the people that you're doing deals with, but I think we've all seen recently you bought from Lloyd's Banking Group. There's been a deal along the way with Credit Suisse. There's something with a German government, the Bundesbank or something that I've seen written about. But what are the discounts available? Who's selling? How do you get to the table and so on?
I cannot comment on anything that he mentioned. Unfortunately, second point, I'm not into the prime real estate business, so I was a bit silent when they invest direct. We provide solutions. We are a solutions provider to the banks mainly. And if there is a distress in which we can capitalize, and we're fully aware on what Bernie is saying, into how soft the economy in Europe is, we see it on a daily basis. We're a big bank, right? We have like 8 billion that we bought in the last 4 years. And we see it on a daily basis when you are renewing one lease, at what rents the level they come. So when you're doing in the Dutch market, you sign a lease for 5 years, and you have to give 3 years for free, plus maybe invest a year of rent in capex. Or when you are, you have a property, maybe an industrial shed in UK, coming out of a dodgy portfolio, and the roof is falling down, and you have to invest the capex to replace it. So we see in the day-to-day all this distress that you're talking considerably, impossibility to get financing, but not maybe for us, because we get financing at the loan star level, but it's, you know, our buyers. We are in the business in which I personally, our GPs, make money when we distribute the money back to our investors. How is it that we get these opportunities for us? Look, there are not too many players in Europe who have the infrastructure that Lone Star has, which is called Hudson Advisors, in which we have these 300 people in which they're completely aligned to our business plans. The education of their children are tied up on a bonus, which is subject to them achieving a business plan, which is the one that we approve the deal at the day one. We have that core competence that ends up bringing benefits to the banks that they need to dispose because they're going through a merger process, and the bank buying that bank doesn't want that exposure into the real estate in Europe, or the analysts are hammering the bank and they want to show a clear message to the whole world that they are completely out of the commercial real estate financing business in Europe. So we provide a solution to them in which pricing at the end of the line maybe, I cannot comment on discounts because also sometimes there are some structures which distort the real number that you end up paying. But you end up providing a solution that helps the banks. We do a business which sometimes the LPs, they cannot do it directly because they don't have the ability to execute those trades, because you bring credibility by actually executing what you were believing to do, and you have the highest rated in servicer in Europe. You're able to raise some new financing, and then you bring liquidity to the market because we sell, which means a lot of people here, maybe they're buying assets from us, which at one moment they were at a level within a bank, which are the largest owners of real estate in Europe, at a level in which they couldn't trade, but because we did that acquisition and we have a clear focus of disposal, you may end up being able to buy from us. Our main counterparties to deal with are banks. And discounts, I cannot comment on that, but it has to allow us to make our returns and execute a credible business plan.
May I throw out a question to everybody here, and that is, there's a lot of talk about distress, and certainly from time to time distress opportunities do present themselves with banks, with property companies, with funds that may need liquidation. But there's one area that doesn't really quite fit for me, and that is to the extent that the European banks are trying to fill a capital hole. If they sell their assets at a distressed price, doesn't that make the hole deeper, not solve the capital hole? And I think about this situation that's been getting a lot of press. I guess BNP Paribas owns 50.5% of Klépierre, and there's investors out there that think it may be their God-given right to buy those shares at a 30% discount to net asset value. But if I were BNP, I'd rather think that at 30% discount to net asset value, I think I'd rather quite like to own the assets as opposed to giving it away and making my capital hole deeper, not more shallow. So all a long way of saying, where is the distress? Because I do think that a lot of the banks need to have actually well-priced deals in order to meet their Basel III requirements, et cetera.
Look, I fully agree with you. And where is the distress? From the bank's perspective, if the value that they have on their books doesn't allow us for buyers to actually bid at a level in which we can make money, we don't even have a dialogue. If we cannot provide a solution to hit ourselves, our heads against the wall, we don't lose too much time. But the opportunity comes at one moment with a particular exposure that they want to get out, that they need to get out, that they don't have the ability to manage themselves, and that's when we come in. It's not easy. It's not, something that comes massive. But today, in terms of volume in Europe of our product, we see a lot.
I'm loving the fact that Juan presents Lone Star, and it's up to him. But a solution provider almost makes him sound like a charity, and I've heard that from other firms. To be fair, particularly private equity firms, because of course, if you're a government-backed institution, let's say that is selling real estate, I think the last thing it wants is to be seen to be selling to what others might call vulture funds, an unkind description, but you get the drift. These guys are trying to make 20%. And it strikes me, Juan, actually, it's interesting. Your company will be dealing with these government-backed institutions, and I guess that's it. You have to come to the table as a solution provider, right? Otherwise, deals won't fly with them. I mean, how structured, therefore, are these deals? Are you just buying them, taking them at a big discount, or are you having to sort of make them highly structured so that you leave something in there for the institution?
We are a solution provider.
Come on. Who believes him?
And we are a solution provider that gives certainty of execution. So we don't talk too much. We get things done. So whenever they want a solution, we bring it to the table, we execute it, we close it. In terms of having banks, governments behind, it's an extra party involved on the discussions. It might take a bit longer for the decision making to be made. In terms of the structures, it's on a one-on-one case. So if you look at the deals of banks disposing on the first wave that I called, 08, 09, there was absolutely no financing available, and you had to rely on some sort of vendor financing by those banks to us when we were acquiring those deals. It was cheap financing, and the good thing is there was no external parties, so you were dealing with one entity to both agree on what was the value of the assets and what was the level and price of that financing. Just as I was checking on one presentation, I think we repaid of that financing in the last 3 years over $1.7 billion in Europe, which means we also, post-closing, we deliver. And it's a lot of work, of daily work, of selling individual small 5 million properties one by one. On the new wave of deals, there is ideally, they don't want only a capital solution, they want a liquidity solution, so there is no vendor financing available, and it makes the deals more complex because you need to raise third-party financing, which is very tricky. The terms are really tough, so you end up working for those banks for the first 2 years on a full cash sweep yearly basis to repay this new, genuine third-party finance. On the equity side, there are some structures, but it's down to, we're flexible. We tell them, let us know what works better for you. We know them all.
Yeah, just on financing, if you have a €1 billion deal, let's say, that you're in the middle of trying to buy, just how difficult is it financing that? Will it take you a long time, millions of calls, or is it one call to burn it over here, or what?
Today in Europe, if you had to raise €1 billion of genuine new third-party financing, I wouldn't say impossible because we like to be positive, but very hard. We need to look at what the interests are. So if it is Klépierre and BNP Paribas is behind, and you're providing them maybe a capital solution, maybe they can provide you some leverage. So we always look at the parties who get the benefits out of the deals that we're doing, and we try to bring those banks on the financing because they're getting the solution on some other way. And they believe on our ability to repay, so they're willing and able and capable of financing loans today.
And to get a sense for the scale of opportunity, I saw that CBRE recently said that in 2011, it recorded about 20 billion euros of deals, sales by banks, let's say, of the type of deal that Juan does. So 20 billion in 2011. CBRE predicts that, well, as we sit here today, there's at least another 13 billion in the pipeline. Do you recognize those figures? What scale of opportunity is there for Lone Star this year in terms of more deals?
There is yes, I would say it's way more than that. The pipeline is fat, it's just the ability to really execute. Yeah. So we look at the whole pipeline and we put them in order and priorities. Okay, what can be actually closed? But the wall of opportunities that is hitting today is huge.
Yeah. just to take a time out from distressed pools of loans, you reminded me of something to do with Peter, actually, when you're dealing with government. Peter's got a great story, actually, about dealing with governments. He knows what I'm referring to, because the Wellcome Trust last year was all over the front page of the Financial Times. They, you know, were very interested in buying the whole of the Olympic Park in London, and ultimately it was unsuccessful. Just curious for a couple of minutes, Peter, to understand your experience of dealing with the UK government there, and if it holds any lessons for us going forward when you're dealing with state entities.
Right, so I'm almost going to have to be as careful as Juan has just been dropping me with that question, Robin. Thank you. So it is quite public that Wellcome had an idea that, as the government looked at what it would do with the 500 acres of what is known, going to be globally known as Olympic Park, Wellcome had an idea that by owning the whole thing and managing it as an estate landlord cohesively, with a sort of a single focus, would deliver more value back to the UK taxpayer over the long run than the strategy that was to be employed, and indeed has been employed by the UK government, which is to sell the individual pieces of it separately over time. It's fair to say, as Robin points out, we were not successful in persuading the UK government that that was indeed the right thing to do, and they have disposed of a major piece of it separately. And so, as our interest was in the whole, we have withdrawn from taking further part and interest in what is now the residual bits of it. I really do have to be quite careful what I say here. It was quite difficult to deal with government in that particular instance on something that was so high profile and so political. And if you like, what I was struck by were a number of things, one of them being the sheer number of different individual government bodies that had a stake in this in some form. So you had a variety of conversations that one needed to have. And one of the lessons is, I guess, it's really, really hard to bring all of them to the table at the same time and expect them all to look in the same direction at the same time. And notwithstanding, wouldn't I, say I think we had a great idea, and by the way, I believe we could have executed on it. Nevertheless, unfortunately, the pressures that are on government at the moment meant that the bird in the hand was more attractive than 2 or possibly 3 in the bush.
Okay, thanks. By the way, I'm not going to ask Juan his opinion of the UK government, because what what we haven't told you is Juan is Argentinian. So, as you'll know, I'm referring to a little bit of a dispute between the UK government at the moment and Argentina, unfortunately, over a piece of real estate, you could say, off the coast. So I'm sure, and I'm not going to criticise either, because my wife is Argentinian. So I never disagree with my wife. Thanks, guys. We've covered all sorts of things to do with real estate. By the way, you are the organisers would like me to open up the mic to people that would like to ask questions. Typically, your questions are likely to be better than mine. You're real estate professionals. After all, I'm a journalist. There are 2 people with microphones that can just come down the aisle and give it to you. I guess, has anybody got anything that they would just like to shout out right now? We've got one there. If someone with a mic could come straight down. Please put your hand up again so the lady can see you. And MIPIM asks that you just introduce yourself, if you wouldn't mind, your name and organisation.
Renay Onur.
Try, yeah.
Renay Onur from MB Holding. Actually, I'm quite curious about what Peter and Bernard will say about Robert's question regarding the distressed assets, because it's only Juan took the question and we couldn't hear about what the other 2 guys are thinking about it. That was a question which I was also curious about. I mean, how come the banks are selling those distressed assets to close the holes in their balance sheets, but at the same time, actually, they are enlarging the hole in their balance sheets? And what would you say about this?
So I'm not a banker, and I don't understand, I suspect, to the level that I need to answer this question properly. But I think there's two dynamics at play here. The first is the first, if you like, is the value of the real estate as against its loan to value, okay, in their books. But the second and really important piece of this is the capital they have to allocate against that in their books. And so it can make sense for banks to sell loans in order to free capital from a Basel III capital allocation perspective, rather than just purely looking at the value of the property against the loan that they've marked against it. Whether we would look, I mean, and the second point I think is the embedded question of would Wellcome find distressed assets interesting to buy? Yeah, we would. We would need a very strong partner with infrastructure in order to do that. We don't have that internally. But my observation at the moment is there is quite a lot of risk being taken in the distressed deals that I've seen being done. And there's relatively few people out there that are competent to take them. This guy is competent to take them with the history and the precedent of what Lone Star has achieved. But we would find the deals that we find interesting, we think are too highly priced, so we choose not to participate. And those that we, and then there are a number out there which we think are too risky for even us to take on.
I'm not a banker either, but I'll attempt at answering the question. I think that is actually one of the hurdle, I think, for why the bank are not disposing of their loan books faster than they are. Quite simply, they don't have the capital or the profit to absorb the losses that they have to absorb. If they have to sell those assets to people like Juan and other distressed buyers, because it means that, you know, their capital is already very under severe strain, so you have to take the losses. You can imagine what happened to all the bank capital with Basel III coming and so on. So I think the bank is just holding on, and also there's a hope perhaps that the market is going to bail them out. That why do you want to sell in today's, if you call it distressed prices? Bank has put some good assets on the market, and they have sold at some pretty incredible prices. So they say, look, well, you know, if I can sell this asset at such a cap rate, why would I sell my loan at such a big discount? Eventually, market's going to come back. I'm just going to hold it. I'm going to wait for the market to come back before I crystallize my loss. And I would look foolish if I crystallize a 30–40% loss today, and the market come back tomorrow, and in fact I can make more money from where I can today. So what are the bank doing? I think the bank has done some structured deals. You know, they have in one instance where they have actually sold a minority stake in a portfolio to a distressed buyer, and they kept a majority interest in the portfolio still, and they will pay the operator in this case to manage the assets, manage the portfolio, and they will participate on the upside. But the idea is they will give a 25% interest in the portfolio to somebody to asset, because the bank hasn't got the infrastructure to manage these loans and properties. You know, banks are probably one of the biggest property companies in the world right now. Just look at their loan portfolio and how much property the bank controls. They're probably bigger than any property companies that you can think of by a large measure. And they can't manage it themselves, so what do? You know, some of them try to build out the infrastructure, bringing a few hundred people to manage it. And some has chosen to outsource it, if you like, but kept a majority interest in the portfolio and hope to continue to participate on the upside as the loans are worked out or assets are turned around and repositioned and sell. So I think that's what, I don't know whether that answers the question. Okay.
He's nodding. We have a question,
yes,
but one for here.
Good morning. I'm Giacomo Catalano. I'm representing my own company based in 1977 by my parents as a consulting and brokerage firm. This is my 9th edition. and I would like to do a question to Mr. Weber. I would like to learn your perspective regarding the next months in real estate activity, and when you see a more dynamic market, and what kind of approach the equity investors will have during the coming year. Thank you.
To answer that question well, you almost have to span the globe in some respect. Maybe just to touch on a topic that hasn't been mentioned, in the emerging markets, people have been generally de-emphasizing two of the BRIC countries and re-emphasizing Brazil and China for different reasons. But you're seeing an awful lot of equity capitalization in Brazil, mostly on the development side. Similarly, in China, I think there's a general view that notwithstanding government intervention and the possibility of soft or maybe even harder landings, that the trajectory for China property is going up and to the right. And so there's a lot of emphasis on those two markets. Japan, I think, is quite quiet. Juan, you mentioned before we started chatting that they're seeing it the same way. It's just structural and natural and demographic issues in Japan. From a U.S. perspective, I was commenting to Peter earlier that the biggest challenge that we're finding is high quality deal flow. There's a lot of money, there's a lot of opportunities, but there's also less transparency and less really interesting opportunities today than I might have thought would have been the case as recently as fourth quarter of last year. But you continue to mine, you continue to dig. From a European perspective, I think that everybody's still waiting for the dam to break at some level. We are seeing interesting transactions. We're deep into a situation just broadly in the Benelux region, to not give too much detail, and we're really trying to solve complex problems and get paid for it. So I think it really depends a great deal. I think investor demand is quite focused on the U.S. It's seen as a safe haven. I think investor demand is muted and cautious in Europe, and in Asia, I think it's very country specific.
One of the things that amuses me, and Rob is too polite to say this, is that whenever I go to the States, I'm constantly struck by the US perspective of Europe, which is that Europe is a complete basket case. And so when you think in terms of most of the money around actually is coming out of US investors, actually there's a real problem in investing in Europe, because whenever you listen to the news, whenever you talk to people, they think that Europe is never going to recover at all. And you're too polite to say that, but that's one of the challenges that are out there. Yet if you're a European, you sort of take a relatively more optimistic approach that there is a way through this, and actually the way that Mario Draghi is handling this does give you some sense of optimism that we will eventually work something out.
Working? Okay. Hakan Gümüş from EA Real Estate Development. And I'd like to address the question to the panel and whomever is interested. We all know the situation in Europe, the economic conditions, and just on the edge of Europe, we have the Istanbul market. And I'd like to ask whether they find interesting the commercial real estate market of Istanbul to invest in the near future.
Yes, but the biggest challenge of investing in Turkey is who the partner is going to be and who is going to operate, and the terms and alignment of interest that you can achieve. And so, in principle, fascinating market, fascinating demographic, on paper, really, really interesting, but I really struggle to find partners that we would be comfortable with and have got a long enough track record of being able to prove that they are investable. So you can't ever separate the real estate from the people. It's still a people business, and whilst the bricks and mortar stand separately, without the right people and being able to trust them and knowing how they operate, it's very difficult for us to move into that market.
By the way, I'm assuming you are from Turkey, right? So you're a Turkish real estate. I mean, you would have noticed that in 2006, 2007, not these guys, but private equity real estate funds were going into Turkey, weren't they? And they were buying particularly retail shopping centres, correct?
Yes.
And I understand their experience has not been an altogether great one for one reason or another. So yeah, I'll be curious to know from yourself how that's played out actually. Have they managed to exit some of these things? Have other people taken over the management?
Well, actually, I don't think that they all have bad experiences, let's say, in the Turkish market. But of course, 2008 was the milestone because many international investors, they moved out from the market because of the global crisis. But now, as far as I can see, because of the European markets slowing down, many investors are still searching for opportunities in Turkey. I see mostly they're interested in office developments rather than retail developments because retail market in Turkey is about to be saturized. So they are mostly looking for office developments.
And just to round that out, I know there's a firm, I'll probably get the pronunciation wrong, but it's Bigili. They're raising a Turkish real estate fund and they've had some success, may have held a first or second close. So there is some traction there for sure. Now, we're out of time. We have been out of time for some 10 minutes now. So I don't want to get myself into too much trouble, but are there any other questions? I can probably take one more. If not, well, now's the time to put your hand up. Any final questions? No. Let's just thank our participants. Thank you very much. Thank you.